Hey guys, this is Vishal from Uncharted Effects. Before we begin, if you enjoy my content, please like this video and subscribe to the channel if you already haven't. I just want to do another quick video speaking about gold. So I did a blog post on why I think everyone should be watching this weekly chart here on gold. So let's just look at the technicals before we talk about geopolitical and economic repercussions. This level here, which is the 13, let's call it the 1360 level, and I'm looking at gold on the weekly chart. Very, very important zone. Why? Because we have tested this area. 1, 2. I'm just going to draw this over. 3, 4, 5, 6. Maybe you can even say 7 here. So minimum 6 times. We've tried to break out of this zone multiple times. The past couple of years, and we haven't been able to break above it. Now I am watching for this higher low here. We have a swing here, a higher low on the weekly chart, and this higher low is confirmed because remember we have this breakout at this candle, so it's confirming a higher high on this trend line here. So watch this zone. Again, a lot of the talk on why gold is going up is that people are pricing in Federal Reserve cut. So generally the idea for getting into gold is because gold doesn't yield anything. There's no yield in it. It's just like cash. Cash doesn't yield anything. That you would put your money in gold when real rates are low or yielding 0 or negative. So to speak about nominal and real interest rates, nominal rates is what you hear about, right? That's the, okay, this is the rate, 2%, 3%. That's the rate that you always hear about, right? Real rates are nominal rates adjusted for taxes and inflation. So, for example, the Fed rate is 2.25%. Your banks might, give you something else in your savings account. I'm just going to use 2% just for this example. Let's say inflation is 1.5%, 1%, 2%. So get your nominal rate of 2%, subtract it with the rate of inflation. Let's just say 1%. And then adjust it also for taxes that you pay for dividends, which is pretty low, but maybe 0.25%, let's say, or even more. So that leaves you with something like 0.5%. Of course, many people actually think inflation is much higher than what's stated, which means that real rates, even though nominal rates are like at 2%, 2.5%, real rates are close to 0 and could even be negative once the Federal Reserve actually cuts rates. So in situations like that, that's why it's nice to hold gold. Gold always has that. The school of thought about gold is it's an inflation protection because of this. Because as rates are low, you might as well hold gold. Because again, when I think about inflation, when people generally think about inflation, inflation means that your currency is weakening in purchase power, which means you need more of your currency to buy goods and services. So let's look at 2 reasons why gold should be on your radar and the economic and geopolitical issues that can stem from this. If we see this break here, I'm going to be... what I want to see actually before we get to that is I want to see a nice weekly break, and I want to see this break sustained for a bit, maybe for the week advance. I don't want to see a break. I don't want to just see a break of this, and then I don't want to just see the following week we close back below that zone, right? That's a failed breakout. I want to see a break, and I want to see price maybe sustain this level for a week or 2. That's what we want to see. When I see this, it makes me think about economics and geopolitics. So let's look at some of the geopolitical issues of reasons of gold breaking this level. First of all, you need to realize that a lot of central banks recently have been buying gold. I know a lot of people hear about the Russians, the Chinese, the Turks, the Indians, even Iran. This could be for 2 reasons. One, like I said, it can be for a way where we might be returning to a stable money, classical economics school. Essentially, if you look at economic history, there's been two schools of thoughts. There's been classical economics, which is basically low taxes and a gold standard or stable money. And then there's mercantilism, which is now called Keynesian economics. There's also the Chicago school, that's Milton Friedman. But it's more about, I would say Friedman school, the Chicago is like in between. I'd say it's in between. But the Keynesian school, or mercantile in general, is about soft money, so fiat money, money that can be traded free floating, and that way government can devalue it for political reasons, and essentially it leads to a big and more powerful government. So history goes between cycles of that, so we might be at a point where the East knows we can revert back to a hard currency. A lot of people disagree with that. But let's see, I look at history as cycles, and I can very easily see that could be a reason why the Chinese and the Russians are holding a lot of gold. And well, the second reason is that they're holding it as a way to get away from the US dollar. If you follow my work, you know that I've said that I believe China and these other countries will have to attack the demand for US dollars in order to hurt the US economy, because the US dollar is the reserve currency. There's this artificial demand for it. The French call it exorbitant privilege, and also because of the dollar being a petrodollar, there's always demand for it, for oil, and that gets to Iran. They accept nothing. They don't accept anything except they don't accept they accept any currency except the US dollar. So again, they could be stealing market share from, say, the Saudis and other Arab states, because as the dollar gets higher, countries such as India and Turkey, South Korea, Japan, a couple of European nations, they just can't afford to buy oil for American dollars, because their currencies have been demolished because of it. So back to gold. These central banks in the East could be holding it as a way to get away from the dollar system when they do their eventual attack on the US dollar. And that's going to be, remember, they're going to try to affect the demand for dollars. So they're hoping that as the dollar gets stronger, and then they shift out of the system, more countries will voluntarily give up using the dollar because it's just too expensive for them, because the dollar is just way too strong for them. And just to remind you, the Russians use the gold very nicely as a way to combat sanctions against Russia. So as the US dollar to the ruble declined, the ruble declined against the US dollar. In gold terms, gold was going up in ruble. So the Central Bank of Russia sold a lot of its US treasuries and bought gold as a way to hedge from this. So essentially the money that they would have lost with the ruble taking a hit on dollars, they hedged by buying gold, because the price of gold in ruble terms went up. So that's another tool. China also had their Shanghai oil contracts, future contracts. So their idea is, basically these Eastern nations, none of them really want to hold the Chinese yuan, the Russian ruble, the Iranian rial, the Turkish lira, Indian rupee. None of these nations really want to accumulate large currencies of that sort. So the idea of gold is gold will be a way to settle the balance of payments. So for example, China will say, okay, we'll buy oil in yuans. An exporter will sell the oil to China using the Shanghai futures market. China will then pay yuan for the oil. But then, since a lot of these banks and exporters don't really want to hold the Chinese yuan, China will offer to convert that yuan into gold. And then the exporter can take that gold and change it back to their local currency. So what you should note from that is that the US dollar was not used as a way to mediate or be the middleman, which is generally is the case with oil. So that's another aspect of gold. Finally, in my research, in economic history research, I believe that gold is a confidence crisis asset. So if you look throughout history, periods of hyperinflation and inflation come in terms of, or come in forms of a confidence crisis. So generally, in a confidence crisis, people lose confidence in the government, in the money they hold, the fiat money they hold, the central banks, and basically the cash becomes worthless. Of course, another way to look at it is that the government prints so much of that cash because they can, because it's free floating, that it destroys the currency anyways. But I argue that it's actually a confidence issue that creates this problem, that actually creates inflation and creates hyper inflation. People just don't trust the currency and would rather hold anything besides the currency because they've lost trust in, say, the government or whatnot. So again, we'll look at gold. We'll look at the miners quickly. Gold's been going up. Oh, okay, never mind. So we are getting a bid now on the miners. So GDX are the miners, GDXJ are the juniors, and I also look at the Huey. So we are seeing the miners go up. Sometimes this isn't the case, even though gold is going up, the miners might not be going up. But follow this because this is going to be very important, because if we do hold this level, break above this level, I am thinking there's a bit more of a confidence crisis issue happening. And a lot of people believe that there's an inverse relationship between the dollar and gold. I just want to point people back to 2008. Gold and the dollar can move up together. Both are safe havens. Gold is, what do you call it? It's more of, like I said, I argue it's a confidence crisis metal, where the dollar is more because it's a reserve currency, so people run into it. So people, I believe, will initially run into the dollar, will run into the yen, the Swiss franc, but as people realize a stronger dollar just causes more problems in the world, money will eventually go to gold, and it's because it's a confidence crisis. So yes, we will be able to see gold and the US dollar rising up together. I want to show you this. This is the gold to silver index. Gold, oh wow, so it's the highest ever. This is the spike we had in 2008, and you see we had this big fall. So again, when you see a fall, that means gold and silver and platinum prices are rising, and we're actually the highest it's ever been. So I have this trend line here, and I am watching this, and I know many other people are watching this as well. Once we get this break of this trend line here, I'm expecting big gains on gold, silver, and platinum. So remember, this is more due to economics and macroeconomics. This is more of a confidence crisis issue. A lot of people are realizing that central banks are running out of tools. They have no tools. They can just revert to QE, cut interest rates. That's really it. They won't admit it, but their Keynesian economics has failed, and this is just something that I believe happens in cycles. We've been through mercantile economies in the past, where we had the Dutch guilder and the British pound, even the Spanish currency, their silver coins, which were first they were classical economics. They're following theories, principles of classical economics. They all went to follow mercantile. Of course, it wasn't called Keynesian back then, and those empires declined and basically broke up and weakened. So I believe this all happens in cycles, and gold is still the best form of money. Central banks are hoarding it. A lot of big money is holding it. Ray Dalio speaks a lot about gold. I know even Kevin O'Leary, who is not really a big fan of gold, is not holding physical gold, but I heard him on CNBC saying he was buying some GLD contracts. So this is something to keep an eye out on. course, if you're a trader here in Canada, a lot of the junior mining stocks, which are sometimes below 10 cents, will get a nice pop on this as well. So that's all for me for today, and I'll chat with you guys soon.